Welcome to The Bottom Line, where we break down the current business and economic stories of the day. Hungary and the Czech Republic, those two economies aren't doing too well. These economies used to develop very quickly, but since the post-pandemic period, these countries haven't been able to find their feet. So let's bring in Raffaella Tenconi, senior economist at Wood & Company, to unpack the current situation and what is behind the freshest data as we know it. Good afternoon, and thank you very much for joining us this afternoon.
Good afternoon, everyone.
So GDP growth so far this year, let's start with Hungary. Rather underwhelming, if not poor. For Q2, it's at 1.5%, originally forecast at 2.4% after a year of negative growth. What is at the bottom line of this crisis for Hungary?
Yeah, absolutely. The GDP number was underwhelming. I think there are two fundamental components. One, of course, is the external conditions. Hungary is heavily exposed to exports, particularly car manufacturing, and especially the transition towards electric has slowed down in pace. And when you look at the industrial sector in Europe, overall is stagnating, mildly deteriorating in terms of hiring appetite. So Hungary is a big exporter. That was definitely one fundamental catalyst. The other issue is that although consumption has been better this year, because inflation did come down and real wages moved back into positive territory, de facto the Hungarian consumer remains very edgy. We see them spending 1 month, but then switching to savings on the other month. So you can say that consumption is not on a firm footing. Investment, of course, is weak. And exports are also stagnating. So these are the three key reasons.
And one other issue that Hungary really needs to address is its significant budget deficit, currently at 6.7%. It could face a third excessive deficit procedure within a decade. What does this signify? First of all, how did Hungary end up here, and how does it get out of this situation?
So to really understand the budgetary situation of Hungary, I mean, besides, of course, the cyclical effect of having weaker growth, which is always a negative for the budget position. But I would go back to the pre-crisis period in 2008. Hungary historically was the country among the CEE that had the most pro-election fiscal stance. So in the run-up to the election, fiscal policy would be aggressively loosened and then tightened immediately after election. This cycle was broken after 2010, when Hungary had its own IMF program, and the Greek crisis triggered a change in the European elections. But what happened with COVID is that the European Commission suspended fiscal rules across the EU. And what we saw is that this coincided with an intensification of election campaigning in Hungary. So the fact of, in my view, the biggest problem in Hungary is that the government does not have the external constraints anymore that kept fiscal policy in order, and has aggressively switched back to this strategy of spending as much as viable in the run-up to the election, which, of course, in Hungary will be once again in 2026.
And in terms of the outlook for the Hungarian economy, because everything appears to be quite unstable, there are certain elements of it that appear quite volatile. In general, the economy is quite feeble, shall we say, low import, low export. What is the outlook for it for the near and, shall we say, the longer term future?
Well, the near-term outlook, is going to be probably a GDP growth around 1.5%, so not much worse than what you've seen in Q2. It's clearly not great, but it's not disastrous. And when you look at wealth accumulated by Hungarian households, overall, you should acknowledge that the situation is still, in any case, much, much better than what it used to be in previous years. The biggest problem, in my view, is the longer term, because Hungary, by intentionally opening many chapters of conflicts within European leaders, it is essentially undermining the EU anchor. So the EU anchor has been very important for all the Central European countries by allowing lower cost of capital, more FDI, more opportunities for trade. Hungary is de facto undoing this process by taking this very tough foreign policy stance. And so the biggest risk is that Hungary is going to go back to where it didn't want it to go. It may lose investment grades in coming years. It may see significantly weakened currency, much higher interest rates, which of course will sap growth further. So the near term actually is not so bad. It's the medium term that very much concerns me.
And just before we move on to the Czech Republic, I wanted to look a little bit outside of Hungary, because obviously Hungarian export markets are suffering because the German economy is contracting. Is this perhaps a signal that Europe needs to face the reality that some kind of Chinese partnership needs to be faced, as opposed to pushing for Chinese de-risking, as much as this is perhaps a taboo topic?
Well, yes. I mean, in substance, it's very unlikely that there will be complete decoupling from China. But the next 12 months are more shaped by, first of all, the US trade policy, depending on which president is going to win. And the second of all, there is generally a problem of demand, because interest rates are very restrictive in the Eurozone, very restrictive in the US. China itself has problems because of the excessive real estate investment it did. So it's not just about the European strategic decision about its China relationship. It's very much shaped by the business cycle in the next 24 months.
And just moving on to the Czech Republic, it's not doing all that much better, actually. 2023 was actually considered a little bit of a mild recession for the Czech Republic. So if we look at the figures that have come out, one could say that the Czech is doing quite well, depending on how we look at it. Perhaps 2024 is a year of solid improvement. So what is looking up for the Czech Republic, or perhaps what is going wrong for the Czech Republic, depending on how we look at it? What are your views? What are your comments regarding that economy?
So if you look mainly at the key macro indicators, I mean, admittedly, the Czech Republic doesn't look that much better than Hungary, right? Because indeed, the economy is slightly contracted. The expansion so far is sub 1%. And it's also a big exporter. So, if European exports or the investment revival that Europe is trying to engineer does not actually happen, then the Czech Republic cannot really grow very fast. And our forecast for this year is 1%, so it's actually lower than Hungary. The difference is in substance. So first of all, Czech households have ample savings. So it's a question of, for them, it's a question of confidence. They continue to choose savings because they perceive uncertainty about the outlook. If this uncertainty were to diminish, they would likely begin to spend more consistently, and they will in any case because of the monetary easing. So the outlook for consumption is significantly healthier than in Hungary. The other issue, of course, is the long-term outlook. I mean, if you look at GDP per capita, Czech Republic has been indeed an extremely successful manager, so to speak, of the EU entry, and because its relationship integration with the EU, its institutions are robust. We think the trajectory remains very, very healthy. It's one of the few countries that will have interest rates of very affordable rates, within the next 12 months, so it can restart the investment cycle, even if the external conditions are not overly healthy.
And as we wrap up, I wanted to ask you about the Czech car industry, which has been, a key factor of growth for the Czechs. But some experts say that it really cannot grow much more than that. What is the forecast for that part of the Czech economy moving onwards now?
Well, I mean, as far as I can see, the Czech Republic is somewhat peculiar within Central Europe in that more companies in the Czech Republic tend to have only one supplier in Germany. So it tends to have a supply chain that is harder to manage when growth is not robust or brisk than its peers. But anecdotally, we work with Czech businessmen, and we see that there is a lot of focus and investment in innovation. So I think, of course, the next 12 months, the car industry is likely to be very lackluster because ultimately affordability of a new car or an electric car depends on your affordability through interest rates and price. So that is very hard to escape. But, you know, if you give them a couple of more years, I think the investment in digitalization will really pay off in competitiveness.
And just one very brief question as we wrap up, the Ukraine issue. How serious is the budgetary situation of Ukraine? We know that the Ukrainian finance minister was asking allies to step up with contributions. What are your comments in regards to that?
Well, of course, until we have the US election outlook, the situation is somewhat more uncertain than what it should have been. There's also a debt restructuring, but that is also proceeding. I think the situation is manageable. I mean, ultimately, the Europeans have made very clear that they will support. So if there is gaps in funding through the US temporarily, the Europeans will step in. But I think the situation is manageable.
Okay, Raffaella, it was great speaking to you. Thank you very much for joining us on The Bottom Line here on TVP World.
My pleasure. Have a good evening.
Thank you, too. That was Raffaella Tenconi, senior economist at Wood & Company. For more business stories, check us out on X and on tvpworld.com. Thank you so much for joining us on Business Arena. I was your host, Marie Cato. Join us again tomorrow at 5 p.m. CET on TVP World. But don't go away. Coming up next, World Talks with Alex Simlinski about the Ukrainian push in Kursk. Goodbye.